Okay. All right, so when we talk of forecasting, this should be, as I said, one of the more engaging topics. A lot of organizations forecast the future, and the biggest reason for forecasting is that we don't know what's going to happen tomorrow. Okay, so to try and gain a measure of certainty about what's going to happen tomorrow, a week, or a month, or 2 months from today, companies engage in forecasting to be able to determine what future demand might look like, and based on that information that the forecast generates, they'll then assign resources in terms of labor, in terms of equipment, to try and make sure that they're able to meet that forecasted demand. Okay. So this chapter talks about what are the different aspects of forecasting that you should know of as a business student. And the beauty of this is that forecasting is not just used in operations management. You can use it in marketing, you'll use it in a whole bunch of other aspects of business. So the basics are pretty similar. How you use it depends on, again, your chosen career path. Okay. So today we're going to look at a couple of things. We're going to look at how managers look at demand patterns, what are the different demand patterns, and then we're going to look at forecast error, which is a big part of forecasting, because obviously we're trying to reduce our uncertainty about the future. So if we're able to capture forecast errors, what's the difference between the actual demand that we're going to experience and what we forecasted 2 months prior to that demand being realized? And if we could get that gap to be as small as possible, then we have a forecast that we can rely on going forward. Okay, so when we talk about forecast, the focus is basically that we're trying to predict the future based on information we have today. Okay, and the information we have today is not often reliable, and information changes very rapidly based on a whole bunch of different circumstances. The example that I think I gave a couple of weeks ago had to do with a company I worked in, where they forecast that the company was going to grow over the next 10 years to an extent where they were going to build a new plant to be able to capture that growth. And when they were doing that planning, that was around 2006. And the market in 2006 looked really rosy for the steel industry. There's a lot of housing, a lot of construction going on. So when they projected that out, they were like, makes sense for us to build a plant in Alabama. So between the time that they did that forecasting and 2007, 2008, where we had the recession, a whole bunch of stuff had changed. And by that time, they'd already committed around $3 billion to building a plant in Alabama. So we have information available to us today that we're going to use to try and project that future. Sometimes that information is not as accurate as we'd like it to be. Okay. But regardless of whether it's accurate or not, we want to try and make that decision as informed as possible with the information we have available to us today. Okay, so when you're looking at a forecast, chances are that you're going to be basing your forecast off of some historical information. Okay, the only time when you won't be able to have that is when you're starting off possibly marketing a new product which has never been sold before. And in that case, this won't really make any sense because you might not have that historical information available to you. But let's start off with a situation where we have historical information available to you. When you have historical information, we have what's called a time series pattern to our data. And we can use this to determine what type of forecast would work best. So starting off with this pattern we see here, this is a situation where we have demand over a period of time, and if you look at the demand, it looks like it's relatively constant over time. Okay, there's a spike here and there, but if you were to draw a trend line, you'd see that that demand is pretty stable in the long term. Okay, so if I have something like this where I have pretty stable demand, chances are that my forecasting might not require a lot of tweaking. Okay, I know what's our average demand. If it's 100 units a month, I'd put a safety stock, which is pretty small, to capture any spikes in demand. But in the long term, this should be the most basic form of pattern that you'd experience from a forecasting perspective. Another common pattern that's witnessed is this demand, and most companies would like to see this demand pattern. You want to see demand growing over time. Your customers want to buy more and more of your product. And how you'd go about forecasting this would differ pretty significantly from how you'd forecast the first one. Because here now we have, we add to our initial demand a pattern known as trend. Okay. There's an upward trend. The opposite of this would be if your product has a downward trend. And again, that's something that you want to capture in your demand calculations. Then we have seasonality to your data. Okay. There's certain things that sell better in certain times of the year, certain things that don't sell at all in certain times of the year. So if you're looking at the sale of skis, for example, you'd expect to see a pattern where sales increase pretty much at the end of the fall, and they drop off pretty significantly at the end of winter. Okay, so this is another pattern that we have, and we have ways to capture that information. And then there's this here. Cyclical patterns are more long-term. So most times when you look at cyclical patterns, we're looking at the 5 to 10 to 15-year time periods. Okay. A good example of a cyclical pattern that we often want to look at is the stock markets. So if I look at the Dow Jones Index and try and pull up the 5-year pattern of, so we can make this bigger. Maybe not. It's in Yahoo. Don't like using Yahoo, but I think it has a better graph than Google Finance. So let's see the Dow Jones Index. So as you all know as business students, the Dow Jones Index captures the health of the stock market at any given time, based off of some math they do on what the average stock prices for 23 or so companies, blue chip companies. And if we look at let's look at a 5-year pattern. I make this bigger. No, I cannot. What happened to all my fancy stuff? I used to like, I can do that here. So if we look at this nodes, and you look at the 5-year pattern, you'll see some trends, like after the recession, there was an upward trend in the stock market and all that. But if you look at it from a cyclical perspective, the things that you'd notice happened every couple of years. So we'd always have a downturn in the economy. Like in 2009, we had a really bad recession. So there was that downturn in the economy. But if you go back 9 or so years, you notice there's a similar downwards trend, which I cannot capture here. Let's use the maximum. So back in 2001, 2002, we had another recession, the dot-com bubble burst, and a whole bunch of internet companies went bankrupt. So the recession there. You go back 10 years, you notice there's another recession. So every 10 or so years, there's a dip in the stock markets. So that becomes like a cyclical pattern where we will have periods of growth followed by some downturn in the market. And from a planning perspective, that's something that I might want to capture when I'm planning for the growth of a business. Okay. So knowing that we had a recession in 2009, and on average there's 9 to 12 years where we're going to have a downturn, that's something that I might want to factor into my forecast. So those are the basic patterns that you'll encounter when you're doing a forecast. Okay. So how do we go about trying to manage demand now that we know that there's going to be some patterns to our demand? There are a couple of things that companies do. Let's start with the second one, because that's a very popular marketing tool that companies do. Why do companies offer promotional pricing on products? You go to lure people in. Okay. Is that Is that done all through the year? Promotional pricing. It depends on the company. If you have okay, so if you have a retail business or a company that has promotional pricing throughout the year, then that's considered a company that has like an everyday low pricing strategy, of which Walmart and maybe Target has something similar to that. But for most companies like Walgreens, they'll have promotional pricing on products maybe once every now and then. And that's usually done when you believe that demand won't be as strong as you want it to be. And you might want to maintain a level of production such that you're not reducing production. So you'd be willing to lower your price for a period of time to bring those customers in to buy your products in periods when they're not really interested in buying your products. Okay. From a service perspective, we have most service organizations rely on appointments. And that's due to the fact that if you're, say, a doctor's office, you have, say, 2 doctors who can see patients, and they only have so much time within a given day. So being able to have pre-scheduled appointments enables them to figure out how many people can they fit into any given day. And the same thing applies to reservations on planes, reservations on buses, and all that. Okay? So companies do a whole bunch of things that they believe will enable them to reduce uncertainty. And the less uncertainty you have, the greater the chances are that you can come up with a schedule that fully utilizes the amount of resources you have available to you. All right, so I'm going to skip these. So we have 2 classes of forecasting techniques. We have what are called subjective techniques, where somebody just makes a decision based on his gut feel of what the future is going to be like. Okay. So the first 2 that we have here are the judgment methods. Actually, the first one is usually based on subjective approaches based on what managers or people handling the forecast feel the future is going to look like. Okay. So obviously that relies on one's ability to understand the future. And unless you're a prophet, chances are that it's not going to be 100% accurate. Okay. So to get a better measure of understanding of the future, sometimes it makes sense for us to do something quantitative. Take our data, do some math, come up with a figure that makes more sense. So what we're going to be more interested in are these 3 approaches here: the causal methods, the time series analysis, and then the trend projection method. Okay. And each of these have situations where they're better suited to the type of product or service that you have. If you work in a big corporation that has a system like SAP or say JD Edwards or Oracle, chances are that your forecasting approaches will be based off of one of these, and you'll never get to see it because the system's going to automatically run it in the background. But what sets you apart as a business manager is the fact that you know what's happening in the background of the computer. Okay, so let's look at some of these methods, and let's start off by discussing what's the forecast error. So everything that we'll be doing with our forecasting is to try and reduce that gap here. Okay, we have our actual demand figures for any given time period, and the difference between your demand and your forecast is what we call a forecast error. Okay, and this forecast error is something that you want to try and reduce such that your forecast actually matches demand if possible. Okay. The only time when those 2 actually always match is if you have a product where you have a fixed order every month. You know you're going to be, your customers want 100 units every month. And if you know that that's not going to change, you're going to be supplying 100 units, so your demand is going to match your forecast. And if that's the case, then you don't really need to have a demand, because it makes no sense to waste time if you have a fixed demand and you don't really need to figure out what the future demand is going to look like. But if your product's not based off of a fixed order, then this now makes sense for you to try and figure out how can we reduce the forecast error associated with our product or service. Okay. When it comes to figuring out this forecast error, it might seem that simple, but actually there's a whole bunch more to it that you'd have to learn. Okay, so there are different measures of forecast error, and the seasoned forecaster is going to try and use not just one measure of forecast error. They'll use multiple measures. When I was doing forecasting, I never used to use more than 3 of these at any given time, okay? Because they end up giving something pretty similar, but they all have a value and a place for each and every one of these. Okay, so I think the best way to go about this is to actually look at how these measures of forecast error would be used. So we have a cumulative sum of forecast errors. We have a mean square errors, your standard deviation, average forecast errors. So let's look at an example that should illustrate this better. Going to pull this up. Okay, so here we have, let me make this simpler. Too much data would be blinding to the eyes. And let's just start with the these figures here. Okay. So if you remember what we said, for you to calculate your measures of forecast error, you have to have information associated with your demand and information associated with your forecast. So let's look at this information here. We have 10 periods of historical data where we had actual demand and the forecast that the planner had put in place. Okay? And we had to figure out what's the difference between what we forecast and what the demand, our realized demand was. Okay? So for period 1, we have a difference of what? They forecast 41 units and customers demanded 39. So we have a difference of 2, right? 2 units, we're off by 2 units. That doesn't seem too bad. And we can do the same for all 10 periods. Okay, so we get an idea of what the difference is between the forecast and the actual demand. But just looking at the error like that doesn't really add value to my life. Okay, so I want to complicate my life just a bit more because that's what I do. And I could first start off by looking at throwing in a graph just to see what's the difference between these two. So let's insert a quick graph here. What graph do I want to use here? Let's use a line graph. Okay, so I get this visualization that shows me the difference between my actual in blue and the forecast. Okay, and this is what you typically see. Your actual demand is usually more even. Sorry, your forecast is usually more even because that's something that you're calculating and hoping to achieve. What actually happens is different. Okay. Now, if my forecast was good, what I expect to see is that I'll have an almost equal number of points above and below the actual forecast. Okay. So I would expect to see we had 10 periods. There should be around 5 periods above, 5 periods below the forecast. But this is not what I see here. Okay. And if I don't have an equal balance there, then there's something wrong with my forecast that I might want to correct. So let's go back to our table here. Should I share this with you guys? Let me share this with you. Connect. Nope. Where are you? All right, so let's go back in here. And go into Web Connect. So if you could please open your Outlook emails, I'll send this out to you. So slow. Tools. Okay, so take a moment, open that spreadsheet up. Let's go back here. Did you get it? Okay. All right, so let's start with one of the first measures of forecast error. That's what we call bias. So the bias measure of forecast error just basically tells us whether in the long term, is our forecast usually higher than the actual demand, or is it lower than the actual demand in the long term? Okay. So to calculate bias, you basically get your measures of forecast error, the 2, -2, -6, and all that, you sum those up. Okay. And you come up with a number. If I would sum this up for -31. Okay. And then I divide that -31, by the total number of time periods that we have here. Okay. And that will be 31 divided by 10, because we have 10 time periods. And I get a number at -3.1. What that number tells me is that if I was to look at this data, our forecast is usually, on average, mostly higher than the actual demand that's experienced. Okay. So if that's the case then, and I wanted to use that information associated with bias, then I would reduce my forecast numbers just a little bit to bring it into line with the actual demand figures that we're getting here. Okay. So that's just basically a way of ensuring that the difference between your actual demand and your forecast is brought closer to zero. Okay. So this number, this -3.1, should be a number that you want to have ideally equal to zero. If it's greater than 0, then it means that your actual demand is usually trending higher, okay, and that you might need to up your forecast a little bit so that you bring your forecast in line with your actual demand. Okay, so that's basically what the bias does. It just gives you a quick number that you can use to determine. Okay, I usually under forecast demand. Let me do something about it. Okay, let's look at the next measure of forecast error, which is MAD. MAD is the most commonly used measure of forecast error. So MAD stands for the mean absolute deviation, okay? And those three, if ever you're in a place where you don't have access to the formula and you're trying to figure out what is the formula for MAD, just remember that MAD stands for 3 words which actually will enable you to calculate the thing without even having a formula, okay? So the first word here is mean, and mean always equals is the same as average. The average of absolute values, and the absolute basically means that if you have a negative, you're going to remove that negative of the deviations that you get. Okay, so these deviations are the same as your errors. Okay, so basically my calculation of MAD requires me to know what's the absolute values for the error. Okay, so I'll pretty quickly just remove all those negative signs, and I get the absolute values of that deviation or of the error. So in column E, I'll just put the formula the absolute value of column D. Okay, drag that down, and that gives me this just absolute numbers for whatever I have in this column here for errors. Okay, so I've done the A and D. I need to add the mean. Okay, so I get the average. I first of all calculate what's the total here. I get 81, and from that 81, I divide that by the total number of time periods that we have here. So it's 81 divided by 10 time periods. And so my mean absolute deviation is 8.1. Okay, so what does this 8.1 tell me? It tells me that on average, the difference between these two numbers, if you look at them in the long term, you have a gap of around 8 units. Okay, the difference between your actual demand and your forecast is around 8.1 units of product. Okay, So you'd want to bring that number closer to 0, such that there's no difference between the two. But obviously, with the fact that there's uncertainty, that number is rarely going to equal 0. But still, you want to make sure that that number is as small as it can be. Okay. The next focused error measure that we have is the mean squared error. Okay. And again, MSE is basically, you take these 3 letters, tear them apart, you have the mean, which equals to the average. Simple calculation of average. Square is exactly what it says. You're going to square whatever number you get for the error. So you're going to be squaring your errors here, and then getting the mean of the squared errors, and you get a number. Okay. So we start off by squaring the errors, and you can do it with the column D or column E. It all ends up in the same value. But I would always use the actual error itself, because it's the square of the error, and raise that to the second power, and drag that formula down. And so you have your squared errors. Again, you want to get the mean, so you have to get the total first. Auto sum, and then calculate your mean square error. Divide that by 10. We have 10 time periods, and you get a number of 87.9. Now, the mean square error is very similar to MAD. The main difference is that it highlights the magnitude of the error in a way that makes it even more visible than the MAD does. So if you're comparing different forecasting approaches and the minuscule differences, by squaring those differences, you end up being able to more easily determine which of these 2 methods is better. Okay? And anytime you ask if you're given 3 different approaches, ask which of these 3 approaches is better. Whichever forecast method has the lowest MAD, lowest MSE, or lowest MAPE, that becomes the focus that you'd want to use. Okay? Because it basically means that your demand is pretty close to your forecast. So go with that approach that results in the smallest amount of forecast error. Okay. So going off of that MSE, one additional calculation that we might be interested in, which is similar to MAD, is your standard error calculation. Now, MSE is similar to, if you look at statistics, it's similar to a calculation of variance. And SE will be similar to a calculation of the standard deviation, if you look at it from a statistics perspective. So the SE here would be the square root of your MSE, but we divide that by the number of time periods minus 1, because we're dealing with a sample. So we calculate the MSE first, then to calculate that standard error, you get the square root of the MSE divided by your time periods divided by 1. So since I already calculated this, I'll just go ahead and do a square root. Nope. We will use the sum total before dividing that by 10, because that's what we want to do in the next step. So rather than using what I just did, so we'll get the square root of your 879 divided by, we have 10 time periods, so 10 minus 1 is 9. And close that parentheses, and you get a number here. This number is usually pretty close to your MAD, your figure for MAD. And it's just another statistic that you can use to figure out how wide that deviation is. Okay, Questions up to this point? Hope it's not too much information. You guys are sharp. Your minds are sharp, so you're absorbing all this like crazy. All right, let's do the last calculation of forecast error, and that's the absolute percentage error. Okay. So MAPE is completely no difference. It's just that now we are adding a percentage sign to it so that we can better understand that error that we have. That's all we're doing. We're just adding a percentage. Okay. So we take the absolute errors that we have here and divide that by the actual demand that was realized and come up with a percentage. Okay. So for period 1, that would equal 2 divided by your actual demand of 39. And so we have for period 1, the percentage error that we have for that month was like 5%. It's a small difference of 5% between the forecast and the actual demand. Okay, so that's what the actual percentage error is. Personally, I find that more convenient because I can say, okay, 5%, that sounds, that automatically tells you that's a small difference. But if I start having differences like 25% or a difference between your forecast and your actual figure, then that might be worrisome. Okay, so the absolute percentage error just enables us to visualize this, the magnitude of that difference. Okay. Here we had differences, yes, but we're not comparing it to the actual demand. So it wasn't really telling us as much as the MAPE would tell us. So if I add those up and divide by 10 time periods, it tells me that on average, the difference between our actual demand and forecast is around 13%. So that's how big that 8 is. Okay, 8 is around 17%. That difference between our demand and forecast is around 17%. Am I comfortable with that? It depends on the product that you're looking at. Okay. It also depends on the industry. Some industries might be okay with that. Some might want it to be a much smaller margin of error. Okay. So those are our forecast errors, the 4 or 5 different measures that you'd be required to understand. I would say save this spreadsheet just for your convenience. Okay. Questions on the measures of forecast error? Because now I'd like to go into actual forecasting. Where are we? All right. So let's skip the subjective measures. And those subjective measures are important, especially when you don't have historical data. But let's actually look at some forecasting approaches that are commonly used. Okay. So let's start with the causal methods of linear programming. Okay. Sorry, not linear regression. Has anybody here not done any regression? High school, first year, second year, third year, done some regression. So here we're going to use a very simplistic linear regression approach where we look at, rather than doing multiple regressions, just a simple linear regression where you're going to be forecasting something on the basis of some historical information that's been given to try and come up with a forecast of the future. Okay. And basically what we expect with this approach is that we'll end up with, if we were to visualize it, you'll have your demand looking something like that. And basically what we're trying to do is calculate some future time period, if this is time period 6, based off of what that regression line is going to look like. Okay, so let's look at a case. I think cases work better for us. And let's look at the information we have here. The supply chain manager seeks a better way to forecast the demand for door hinges and believes that demand is related to advertising. So the more advertising, the more demand he expects to realize, which makes sense. If you advertise more, chances are that your sales will go up. So the following are sales and advertising data for the past 5 months. Okay. Sales, you see what you expect to see when you have more advertising, like in month 1 and month 5, sales are slightly higher. Okay, and we're told that the company will spend $1,750 next month on advertising. So we're trying to figure out how much sales should we expect if we spend $1,750. Okay, who wants to give it a shot? All right, let's do this in Excel. I think I have this on tab 3, sheet 3. Okay, so we want to try and figure out what our sales are going to be in month 6 based on the information that we have here, and the fact that we're told that how much was advertising going to be, $1,750. So we know this 1.75, right? 1.75. That's how much we have of our advertising dollars. Now the question is, what's this going to be? How much can we project month 6 sales to be? Okay. Now, if we're doing linear regression in Excel, y is equals to a plus bx, we need to know a couple of things. Okay. Right now, we're trying to figure out what our y is going to be. Okay. Do we know what our a is? No. So at the moment, we don't know what our y-intercept is going to be. Do we know what our b is here? No. So that's another unknown. Do we know what the x is? X is this number that we're going to be working in terms of our advertising budget. So we do know that we have $1,750 to work with. So we want to figure out the other two, and once we figure out those two, we can then calculate what our sales would be in month 6. Okay, so let's do this. Let's go into data. Okay, and once you're in data, go to data analysis. Make sure you have data analysis on the top right-hand side of your screen, and look for regression. Okay, and hit OK. Now, you're going to have to input your y information, what's on your y-axis and what's on your x-axis. Your y-axis is always your dependent variable. So in this case here, sales depends on advertising. So highlight just the data for your y range. That would be, yeah, it's already given there. Okay, and your x-axis, you input your advertising spend. All right, and then let's put an output where it says output range. Click somewhere. F1 should be fine. F1 means that your output's gonna be populated right there. So do I need anything else here? No, I don't think I do. And just say okay. Why are they overlapping? C and C. Okay, I made a mistake there. This should be okay. So when you click OK, you get this table right here with summary statistics. Okay, and there's quite a bit of information here that that is of value to me. The first thing that I would look at, let's first of all finish with this and try and put together our linear regression equation. Okay, so A here is a y-intercept, and if you go to the bottom of your output data, your y-intercept here is negative 8.13, right? Next, we want to find the slope, which is given just below that. The x variable 1 gives you the slope as 109.23 multiplied by your 1,750. Okay, and this here is going to give you your solution to what your forecast is going to be for month 6. Okay, so let me plug that into my spreadsheet here. So we have your intercept plus your slope multiplied by your dollar spend. And if you do that right, you get a number. And let me reduce my decimal points. Center. Make it bigger. Okay. So what does this tell me? It tells me if we spend $17.50 in advertising, we should expect around 183. What's this in? How many hundreds of thousands of dollars? Thousands of units. Okay. So around 183 units would be sold within the 6 months. Okay. What else do we need to know from this table here? The only other thing that I would point out here that's of interest to us is this right here. Your R squared of 95, so around 96%. What that tells us is that there's a very strong correlation between your advertising spend and your sales. Almost near perfect. The more you spend on advertising, the more your sales go up. Okay, so that's just something else that you might want to look into. Okay, so this is the first quantitative approach that you'd have. Hopefully, it's pretty simple. Okay, the thing to remember is where do you get this information? What's your A? What's your B? Okay, that's your y-intercept. That's your slope. Add those to whatever figure you're given in whatever question you might have, and you'll be able to come up with a forecast. Okay. Any questions up till here? All right, so we run out of time. So let's call it a day and let's continue next time with our second approach, which is also pretty similar to this. All right. So I'll see you all on Wednesday. All right.